Hey everybody, welcome to you. It's Friday. That means it's Advanced Options Day, and I'm glad to be with you. My name is Brent Moores, and today we're going to continue our series. We started last week. Last week we hit up iron condors. This week we're going to hit up calendar spreads. And the reason I've kind of chosen these first two strategies, advanced option strategies, to start off the series is I kind of view them as foundational strategies as we go forward and learn other potential strategies. Our goal is to expand your toolbox of possible trades, of approaching the market so you can find the right tool for the trade you want. So this week, calendar spreads. Before I get into that though, let me just mention this. I'm joined by Scott Thompson in the chat. I appreciate Scott. As you have questions, feel free to type those in the chat between Scott and myself. We'll do our best to get those questions answered. Also, you can follow us on X at BrentMooreCS, at Scott Thompson CS for additional financial content throughout the week. Now, before I get to the options stuff today, let me just mention this. Options do carry a high level of risk and are not suitable for all investors. The material today is for general informational and educational purposes only. We'll look at individual stocks, individual options. They're not individualized recommendations or personalized investment advice. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And the paper money software application, which we will be using, is provided for educational purposes only. And rolling strategies can entail additional transaction costs. Investing involves risks, including loss of principal. Past performance is no guarantee of future results. And Schwab does not recommend the use of technical analysis as the sole means of investment research. If we put on a stop, probably won't add any today, I wouldn't think, but there's no guarantee that execution of a stop order will be at or near a stop price. And I'm not going to factor in commissions in trades we're going to look at, but that is a consideration I want you to just be aware of here. Let's head on over to that Thinkorswim platform. Nice little modest rebound in the market here. Maybe we'll pick up a little support here, perhaps. If not, we have a couple other support levels on the horizon there in terms of the S&P 500, and we are in earnings season, folks. We had Alphabet already release. We had Tesla release. Next week, we have Amazon and Apple and Microsoft and Meta. A lot of earnings here coming up that can certainly move the market. Now, calendar spreads. Let's kind of go through a who, what, when, where, why on calendar spreads. First of all, in terms of the who is you? I think you can benefit from these, even if whether you choose to actually trade these in your portfolio or not. I think they can be a valuable learning options exercise here for you to learn more about options. Okay, so that's the first thing. What are calendar spreads? Calendar spreads are trades where you're going to do an option spread where you're going to be trading the same strike price. You're going to be selling one, you're going to be buying one, but different expirations. We're spreading out the calendar here, which is why they're a calendar spread. Different expirations. That's what makes them different than vertical spreads. Well, that's one thing that makes them different than vertical spreads. The other thing is you're using the same strike. Now, typically, when we talk about calendar spreads, we're talking about selling the shorter term or the near expiration and buying the longer term expiration. And that's all I'm going to look at today. But if you switch those around, it can be more problematic, partially from a margin standpoint or a options approval standpoint, because you risk the likelihood of if your long option expires, then you're just left with a single short option there, a naked option, which may or may not want to happen. So typically on these trades, we're going to sell the first month. I'm going to go for we're going to look at some examples here in just a sec, but why would you do them? Or, I guess that was the what of a calendar spread. The when, well, when you're neutral, you're looking for neutral type stocks, particularly if you expect implied volatilities to go up because they're positive vega trades. Time decay can help you. Sometimes in your portfolio, you'll be looking for stocks that are, trades that are more speculative on big moves. This is not one of them. Those big move type trades, long calls, long puts, certainly may have a place, but this is an entirely different type of trade here on that. So let me just put down a couple little introductory notes here on our calendar spreads. We're going to do one long contract, one short contract, different expirations, different expiration dates, okay? Same strike. Okay, that's kind of the first thing. That's your definition of a calendar. We're going to sell the near expiration, okay? We're going to buy, we'll just say, I'll add that on the same line here, buy the long-term expiration dates, okay? And they're non-directional, mostly. I say non-directional, usually we think of them as neutral trades. You can skew them as a little bullish or a little bearish depending on what your strike price is. The goal is you pick the strike where you think the stock is going to go. That's the goal. Let me just add a couple more things on here. They're positive theta. Time decay works for you on these, as with a lot of trades that we'll look at. And they are positive vega. Okay, so they benefit if implied volatility goes your way. I'll continue this list as we go forward, but I just wanted to get that, those kind of, some of you like to take notes on these, and you can, whatever you want. You can take a picture or write them down or whatever if you like those notes. But let's go back here. Now, look, we talked about what they are. We talked about what we want to see. We want to see something more neutral, more of a neutral stock, possibly with implied volatilities goes up. So how are you going to find those? Well, we're going to find those. There's different ways to find them. And one approach is just to look at a general watch list. Okay, maybe you have a general watch list. Here I have one that's liquid stocks. If you're interested, this is just a saved scan. And this is basically looking at stocks that are larger cap stocks. I think they're S&P 100, well, they may be S&P 500 stocks, but they're penny increment options that are trading a lot of volume. Okay, it doesn't guarantee every option contract is going to be liquid here. So just be clear on that. We need to check that out. But this list is, and this isn't bullish, bearish, or neutral. This is just finding more stocks that probably have more liquidity. Okay, we'll have to look at the individual options. If you'd like this scan, I posted it in the description of this webcast. Okay, if you're watching live, I'm going to put it in the chat here. Just remember, scans aren't guaranteed for your accuracy or timing on these, but that's the scan there. And this is going to give you can see these are bigger names here. Okay, these are more liquid stocks. There's nothing neutral or bullish or bearish on these. And so what you may do is you may just scroll through knowing that you want something that's more bearish or neutral. You can just scroll through and look for something that's more neutral as you do this. And you may come upon one. And that's fine. As I go down the list, I can look at this and I can say, well, Apple's looking kind of bullish. And when I say bullish, I mean, for the technician, the trend's been going up on Apple. Plus, you may be a little bit deterred with earnings coming up next Thursday there. You can look at Abbott, trending up. So, it's a little bit more hit and miss here on this. And maybe you come up with something like this and you say, hey, Broadcom is looking a little bit more neutral for me. I see something kind of or support level. I see something that looks a lot like maybe a resistance level here, kind of a channel. And I'm thinking this stock may go neutral. Now, that's not a recommendation. This could go up or go down. I'm just saying, if you're a technician and you think it's more likely to go neutral, that may be a possibility here on this. Now, I actually already have a trade in this paper money portfolio on AVGO, but I think it's a pretty good example here. And there's no reason you can't do more than one trade on a particular stock at a time. Just be aware of the other trade that you have on this. So let's say we were going to look for a calendar spread on this. The first thing I want to do is look for the neutral trade. Two, I want to just double check. Ideally, we're going to benefit if that implied volatility goes up. Well, here's our implied volatility right now, okay? Now, here's our implied volatility right now. Ideally, this goes up from here. Now, we have earnings. When's earnings coming out? Let's see. They last came in early June, July, August, September. So early September is probably the next earnings. We got a little ways to go on this. In general, as you get closer to earnings, you expect implied volatilities to go up. That's no guarantee. But that would tend to, everything else being equal, that would tend to benefit the trade there. Okay. Now, George in the chat asked a great question. He said, would you also like scan for IV to be on the lower end? Yes, absolutely. So I wanted to start with just kind of a general approach, and then we'll look at some with implied volatility being maybe on the lower end of things. I'm going to hit that up in just a bit. So absolutely, George, that's a good point. Now, in this case, well, I'm just looking at implied volatility on the chart itself, but you can actually embed that into a scan. Okay, that scan I gave you that I shared is more of a general type scan for most types of option trades. But if you want to get more specific, you could do a higher volatility scan, a lower volatility scan. You can do that as well. And you can also, even if it's not in the scan, you can add it as a column on the watch list, which I'm going to look at with you in just a bit. But if I'm doing AVGO and we're going to do a calendar spread, we got to decide, well, where's kind of our price? And I'm going to say, hey, it's kind of in this range here. Okay. Let me get rid of my cursor. Let me get rid of so I can kind of see. Kind of in this range, so somewhere around the 390-ish level. Okay. So I'm going to look for about a 390 strike. Let's show you how to actually do the trade. I'm going to click on the trade. Now, you can choose different expirations. This is just kind of we'll say this is a starting point, okay? So this is not a recommendation, this is a starting point. But I'm going to say for a starting point, I'm going to say the short-term option, this is the one we're selling, we're going to sell 20 to 40 days. 20 to 40 days till expiration. The long-term option, I'm going to say 50, we'll say 50 plus, how about? Okay, 50 plus days till expiration. So can we do a shorter term trade? Yes, we can do one. In fact, I'll demonstrate one a little bit where we go shorter than that, but that's just kind of a starting point. Now, could they be calls or puts? Yeah, they can be calls or puts. Now, you can't do a call and a put on the same, your short contract can't be a call and the long contract a put. That's not a calendar spread. But you can do two calls or you can do two puts for your calendar spread. Generally speaking, we're going to do them out of the money. In other words, if your strike price is a little bit above the stock price, then we do a call. If the strike price is below the stock price, then we do a call. Then we do a put, okay? Let me just say that again because I may have said that wrong. If the strike is above the stock, we'd probably be looking at call options. If the strike is below the stock, we'd be looking at put options. Now, George says, you can do a double calendar. Absolutely. You could do your call spread above and your put spread below. That's a double calendar. That's probably a topic for another day, but that is absolutely a good point there, George, on that. Okay, let me just give you one other thing. Okay, this is generally a slow moving trade. Why do I warn you on that? Because very often what happens is when you look at calendar spreads, and you're in a calendar spread and you may say, hey, this is going really well. You look up, a week later or something, and you realize I'm really not making a ton of money here. That's unfortunate. Okay. That's part of the trade. The good news is typically if it's going against you a little bit, it's not going to show massive losses immediately either. It's just it's very different category than like a long call or long put here. Okay, so you can see I already have a position on AVGO here, but let's go and let's look at this. So I'm going to go out a little while. I'm going to go out to the monthly contracts here. Okay, so here's the monthly contracts. Monthly contracts will generally give you a little bit better liquidity than the shorter term contracts. What did we say? I think I said about three. We said, well, I'm going to say about 385. So I'm going to go pretty neutral here. Remember, if I want to skew this a little more bullish, I can eke it up a little bit. If I skew it a little more bearish, I can eke it down a little bit. Now, let's say I think it's going to go really bullish. Should I do a 450 calendar? Probably not. You should probably do a different trade in that case if you're very bullish or very bearish. So I'm going to do this 385. And I'm going to do a call calendar. So I'm going to click on the bid price to sell the 385. Okay. And I'm going to go out. And I'm going to go out. We'll go to 50 days, 56 days here. And I'm going to do the same. Oh, I'm not going to do 385 because I don't have a 385 strike. Okay. So let me change that. I'm going to sell we'll sell the 390. I'm going to keep it a little bit out of the money here. And I'm going to buy the 390. You see why I didn't have the choice of a 385 here on this one. I'm going to click on, I'm going to hold down my control key and click on click. Click on the contract. I held down the control key because if I didn't, I would just replace the one with the other. I want them both here. Let's analyze this trade here. I'm going to analyze the trade. Now, notice it's a debit, 333 debit. That's generally going to represent your max loss on the trade. Okay, that's your max loss on the trade. Let me just do this. I'm going to go to, I have the wrong dates here. What did I do? September, that doesn't seem right. I don't think we were doing September. Let me go to, I think we're going to the monthly contracts. August. Okay. So here's the August contracts. Okay, here's my debit. Debit is the max amount that I'm going to lose on this trade. Okay, and generally that's if the trade goes significantly a long ways against us. This is what a calendar spread looks like. Okay, you kind of have this familiar tint type pattern. Okay, that wasn't a very good drawing, was it? This peak is our strike. In this case, we did the 390 strike. Okay, we did a 390 strike. We want the stock to stay around that. Realistically, it's probably not going to stay right there. Realistically, you're not going to get the max gain on this probably. So we'll get to money management in just a little bit, but we're not going to hold out for a max gain. We're going to, in fact, if we got half of the max gain, that would be a good scenario on this. But notice this. This is why people do calendar spreads. They do calendar spreads because the short contract is going to have higher time decay than the long contract. And because of that, what happens is, as you get closer to expiration, the purple line, which represents today's date, today's profit loss, I'm kind of marking over that purple line, is going to get closer over time to the blue line. Okay? That represents that expiration. In other words, as time progresses, this profile is going to look better and better as long as we kind of stay in this area here. Okay? If we go outside this area, if we're looking over here, time decay isn't really helping us out. If we go over here, time decay isn't helping us out. Here, time decay helps us out. Furthermore, if implied volatilities increase, that will tend to improve the situation as well. So there's the directional component, or in this case, kind of a non-directional component. We want the stock to stay in this range. But if it does stay in that range, time decay, and if we do get an implied volatility increase, that should help you out on the trade. Okay? So that's an example of a calendar spread. Let's go. Now, something I should point out. Notice, in terms of this contract right here, we're selling the 21st of August. As we get close to this 21st of August, one thing we could do is we could buy it back, and then we could sell, say, the 28th of August, or maybe the, I don't know, 5th of September. I don't know, I'm maybe off by a day there, but contract. In other words, you can roll it. When you roll, you're going to buy back this short-term contract, okay? You're going to buy back the short-term contract, and you're going to sell one that's in between the first short-term contract and the expiration date. Now, I can't sell September 18th, because if I sell September 18th, that just is going to basically essentially shut down the trade. But so we can look at potentially rolling in the future. That is the trade though, okay? Now, I think on this page, I did the wrong date. This was supposed to be August 21st. And there we go. So I'm going to confirm and send, and I want to talk about managing this trade here in just one sec, okay? But let me just put this, oh, I don't have my groups out there, so I'm going to click on send, and we sent the trade, okay? Now, let's just talk a little bit about money management on this trade, okay? So one thing I should mention is these are generally not high probability trades, okay? So if you're shooting for a higher probability trade, this is not going to be your first plan here on this calendar spreads. But this foundation that we're laying with calendar spreads is gonna lead to higher probability trades, because there's some little tweaks we can do to this trade to make it a higher probability trade. For that, you're gonna have to stay tuned for future weeks, where we're gonna cover diagonal spreads, which are very similar in some ways to calendar spreads, but those we can make high probability trades. So some of these lower probability trades, like calendar spreads or butterfly spreads, with a few tweaks, we can make them higher probability trades. Okay, and so we may roll these, okay, roll if near strike price. We're going to roll this near strike price. We'll say less than, can I find my less than 10 days to expiration, okay? We may roll that if it's possible. May not always be possible to roll, okay? We're going to exit at, I'm going to make it kind of a general wide category, 25 to 50% of max gain. Okay? You can move that up, down a little bit, or down a little bit, but holding out for 100% max gain probably isn't going to happen, because number one, you're going to have to get right to expiration pretty much to get to max gain. And there's always and you'd have to be right at the money. So that would really increase the chances of early assignment on those. Okay. Another exit. That's going to be that's a good exit. Exit with technical breakdown. Okay. If this neutral trade no longer is neutral, if we're turned bullish on this, maybe it's breaking a resistance level, or bearish, breaking a support level, we may look to get out. You got to give it some wiggle room and some time, but if there's truly a technical breakout, we're going to breakdown, we're going to look to get out. And we're going to exit about 1 week to expiration. Expiration. Okay, so I think that's it. Oh, let me just add one more to complete our list. In terms of money management, we're going to say 1 to 2% of active trading portfolio at risk on the trade there. Okay, so there's that. If you wanted to take a screenshot or whatever, that's fine on that. I'm going to go off this and I want to go and I want to we'll look at other examples here. Okay, but I also want to just mention some other things here on this. First of all, our trade hasn't filled. If I want to incent it to fill, if I want to make it fill, I may have to go here and cancel and replace the order. Now look, it's kind of, the current price is a little bit in between the let's do this. Let's go in between the mid price and the natural price and see if we can get that to fill. Okay, there we go. Now that's filled. And when we look at this trade on the monitor tab, what it's going to look like, hold on. What it's going to look like is this. Now, I already had this put contract on here, but I've got the call contract right now. So there's your short position, there's your long position, here's your long position right there. Different expirations, etc. Okay, now let's move forward here. Let me just mention a few little tidbits here before we go to another trade and another scan for a different scan here. Calendar spreads, sometimes you'll hear them referred to as time spreads, okay? Theoretically, you can call them a horizon spread, but I never hear people refer to them as that, okay? So that's the first thing. Remember, vertical spreads, you separate the strike prices. Calendar spreads, you're separating the expiration dates because of the excess time decay in the short contract. That's the goal here. These are defined risks. The initial net debit is the primary risk measure we're going to use at that. That's the primary risk measure. And you can adjust this from neutral to slightly bullish or slightly bearish depending on what strikes you have. In terms of risk, if the price moves too far away, that's a risk. If implied volatility drops a lot, that would be against you. All right. So that's that's something just to be aware of. There is an assignment risk. Remember, short options have a risk early assignment. And there's also, a couple other risks that I should mention. This is true not just for calendar spreads, but other types of trades as well. There's liquidity risk. Make sure you're using more liquid options, number one. And number two, there's event risks, news risks. Earnings can certainly come out there and be a problem. Now, let me show you a different type approach on here. Here's another scan I have. ADX neutral scan. Okay, ADX is just a measure of trend. So this is just a scan. Again, I've shared that in the description of the webcast, but I'll also put it in the chat here. This is a scan that looks for lower ADX values. It doesn't, and so a higher ADX value means it's more trending. A lower ADX value means it tends to trend less. So you can look at these. Here's Alphabet. Well, we just had earnings, big move on Alphabet. Here's GM, okay? Here's Kinder Morgan. That's kind of more neutral-ish. Here's Nike. We actually have an existing trade here on KMI. We have an existing trade on Nike. So, we already did one. So a lot of these I already have existing trades on here. CCL, kind of more neutral, okay? Newmont, maybe a little bit more of a trend. These scans aren't perfect, but maybe it's a scan. One suggestion I would make on your scans is have more than one that are a little bit different. So I have an ADX neutral scan here and looking for more of a neutral type stock. There's a lot of overlap with other scans, but sometimes you'll get some different hits on different stocks that give you some more possibilities. Now, notice what else I've done on this scan. I added, this is to George's point earlier, I added an IV percentile column here on this. Remember, we not only benefit from time decay, we can benefit from implied volatility because this is a positive vega trade if implied volatilities go up. So if we look something with a lower implied volatility, the expectation is, no guarantee, expectation is it may come back to a more normal level. But who knows whether it's actually going to do that. IV percentile, you can add that. If you want to add a column, just click on the gear. It'll give you the choice to customize and you can add columns there. Here's the lower IV ones. Now, if I go here to say General Mills, I end up with something with a higher implied volatility. And those would be less desirable probably from that standpoint. Let's look back at NVIDIA though here, okay? So here's NVIDIA. Again, what I said before in terms of earnings applies. Generally, as you get closer to earnings, such as this last earnings NVIDIA had, implied volatilities will tend to increase. So could implied volatilities go down from here? They can, but more than likely, you'd probably expect them to increase, and that would tend to benefit the trade here on this. Now, let's go and let's look at another example here. So I'm going to go to NVIDIA and let's look. Now, we said last time we did these monthly options, we can do weekly options, but just make sure that the liquidity is pretty good on these. I'm going to do something pretty close to neutral. So stock's about 208 right now. We'll say about 205. Now remember, if I'm doing a 205 option, I'm probably going to do, because the strike price is below the stock price, I'm probably going to do a put spread. So I'm going to sell this. But before I click on this, let me just note, you can look at the bid-ask spread. You can look at the open interest. Notice, even though these are weekly options, we still have a pretty tight bid-ask spread here. It's about 15 cents on a $6 option. That's pretty low. We're over 1,000 on open interest. That's pretty high. That's great. Most stocks you look at are not going to have this kind of liquidity, but hey, this is NVIDIA. Okay, this is NVIDIA. So I'm going to sell the 205. I'm going to go here, and I want some separation between these, especially if I'm going to roll it. Okay, if I did the 28th, technically I could do a calendar spread by not the 28th, the 21st. Technically I could do that. That would give me no opportunities to roll, which that's fine. You don't have to roll it, but just keep that in mind as you do this. I'm going to go to the 205. I'm going to hold down my control key, and there's a put spread. I'm going to analyze the trade. Notice it looks pretty similar to what we saw in terms of the other trade. You still kind of have that tent shape. We still have the issue of if the stock stays in kind of this middle range, time decay, that's the purple line, is going to be moving up. It's going to be helping us out. Implied volatilities, if that goes up, that's going to help us out. But if we go outside the range, not only is the price going to be working against us, but time decay will work against us out here as well and out here as well. So neutral trade, right? And there we go. Let me get rid of my drawing. Let me click here, and that's the initial debit here on this. So what's my risk on the trade? $590 is my max loss on that trade there, okay? My theoretical max loss. Now keep in mind, there's liquidity risk. If I try and get out early, you don't know exactly what price you're going to fill out to get out. Or if something gets assigned, when I say theoretical max loss, I'm just using, this is how that looks there. Okay, so let me go to trade. In fact, let me do this. Let me click on confirm and send, and you can see that right here. Now, notice I have, this is just kind of does the math for you if you want, if you forget that calculation on that. Let's click on edit. Getting filled at the mid price can be a tough proposition. So I'm going to kind of go in between the mid and the natural, and I'm going to send that order there. Okay, I want to show you one other scan here that you can use. And none of these scans are recommended, but I think it's good to have a variety of approaches to finding potential stocks here on this, okay? Potential option trades. So that's the trade. Remember, in terms of managing, once we get to about a week till expiration on these, we're going to exit, okay? A week to expiration, we're going to exit. 25 to 50% of max gain, things are going really well, we're going to exit, okay? Technical breakdown, we're going to exit, okay? Now, when we talk about managing these, let me just point out, I teach a webcast on Wednesdays called Managing Your Options Portfolio, where we look at a variety of different trades, not just calendar spreads. We look at a variety of different trades and talk about managing those each week, okay? All right, now, here's this. Let me click here. Now, question. Greg says, do you have time to explain the strategies for a double? I'm going to be quick on this, but let me just kind of show you this. This is the calendar spread. Okay? This is the one we just submitted right here. That's what it looks like. That's a put spread. Let me do this. What if we did a 215 call spread on top of that? Look what happens on this. Well, maybe just to make it a little more clear, maybe I do I'm going to go to 220 on this, just to spread those out a little bit. Okay, now look what happens, okay? And I'll go in this more in depth later, but I have basically a calendar spread here at the 205. I have a calendar spread at the 220. When you overlap the two things, that's what it looks like right there, okay? That's a double calendar there, all right? So that's just a brief preview of what a double calendar is. Again, we'll hit those up in the future, but just for those of you who are curious. Now, let's do one more. Let's do one more because I want to show you one more scan here at the risk of inundating you with scans today. I'm going to do a scan that's I have one that I created, which is just kind of a neutral options scan. And if you look at this scan, if you look at these results, there's fewer results on this, but there's a lot of overlap in results on this. So if I wanted to, let me share this scan with you. Okay, so we're just sharing 3 scans today. And for those of you who are watching our recording, at the risk of repetition, these are in the description of the webcast there. Here's a neutral options scan. I can go through and do the same thing. It doesn't mean these are all appropriate. This scan has nothing to do with implied volatilities. I added that implied volatility percentile. So I'm going to be focusing more on these that have this lower IV percentile here on this. AVGO, kind of more neutral. Now, it's funny because alphabet has popped up on a lot of these scans. This gap down yesterday makes me, look, I'd probably call this kind of a support level here. We gap below that. It was kind of going sideways. At this point, I'm not sure I would consider this sideways. So even though we have a scan, even though this says neutral, you got to be willing to be discerning in your eye and say that probably doesn't fit the bill here. Here's GM, pretty neutral. Okay, we've already looked at a lot of these. Maybe not so much on NEM. Carnival Cruise, Yeah, but that'd be relatively new. So you can look at these. Some of these are looking at kind of higher implied volatilities. Okay. Now, I mentioned a bunch of things with calendar spreads here. In fact, as we're kind of wrap up, let me just kind of bring this over, and just in case you wanted to write any of these things down here. Remember, with calendar spreads, they're more neutral strategies. If I'm a little bit more bullish, I can knock that strike price up a little bit. If I'm a little more bearish, I can knock it down a little bit. But there's price risk on calendar spreads. If they move a lot, it's not going to work well for you. Time decay is your friend on calendar spreads. Volatility helps if it goes up. It hurts if it goes down. These are slower moving trades. But that's how you place the trades. We covered that. We covered how you manage the trades as well. Great. That's what something we'll hit up in our Managing an Options Portfolio webcast. Now, if you'd like, I'm doing a whole series on different option strategies. Okay. Last week we did iron condors. This week we did calendars. In upcoming weeks, we're going to do other strategies, such as diagonal spreads, butterflies, unbalanced butterflies, double calendars, jade lizards, ratio spreads. We're going to do all these in upcoming weeks. So don't miss them. If you like the webcast and you don't want to miss the webcast in the future, not just this webcast, but other Trader Talks webcasts, you need to subscribe to the Trader Talks channel. Not only does it benefit me, it benefits us, it benefits free education, it benefits you because you're not going to miss webcasts. There's millions of videos out there on YouTube, and to sort through the noise, subscribe to Trader Talks webcasts. If you liked what you saw, I do appreciate a thumbs up at the bottom of the page. That would be your favor to me. But if you didn't, that's fine. I'm glad you were able to spend your time with me here, and I appreciate that time you spent. Coming up next, we have market and sector analysis. Mike Fairborn teaches that webcast. It's a great webcast. Thank you for your questions. Thanks for your participation. Thank you, Scott Thompson, for helping me out in the chat with those links. Remember, if you want to see other sessions, check out that playlist for the webcast. Have a great rest of the day and a nice weekend ahead. Bye-bye, everybody.